with a decision maker, moderated by Marc Norman, the Larry and Klara Silverstein Chair and Associate Dean at the NYU SPS Schack Institute of Real Estate, and the decision maker, Kathleen McCarthy, Global Co-Head at Blackstone Real Estate. Please give a warm welcome for our speakers.
What a day. Amazing also to go in the afternoon because we now have all the insights of debt, equity, the governor, Larry Silverstein. We're really lucky today to have Kathleen McCarthy, Global Co-Head of Real Estate at Blackstone, one of the largest private equity investment managers in the world, 160 billion in investor capital under management, and in this current market in many sectors, making the market in others, figuring out in our post-COVID world, in our inflationary environment, how to sort of settle into a new normal of sorts. And this conversation is incredibly timely because we're standing near the fourth quarter. The Fed rate decision we've seen, we're at the verge of the start of our presidential cycle. And so I feel like there's nobody better to have these conversations with than Kathleen. She previously served as Global Chief Operating Officer for Blackstone Real Estate, and before Blackstone, worked at Goldman Sachs. And so, Kathleen, it's been quite a year. We've seen the collapse of regional banks, demise of WeWork, re-regulation of Airbnb, and we've also seen people handing back the keys of office buildings. And we've talked, of course, and the governor talked about affordability. I'm just wondering if you could talk to us about what you're seeing in Blackstone's portfolio.
Absolutely, and thank you so much, Marc, for having me. And I'll just start by saying, to tie into the last panel, I am an optimist. I love that idea of being addicted to hope. I sleep really well at night. I am grateful to be the recipient of articles from Bill Rudin at all hours of day and night. And I also think it's really important to keep things in perspective and recognize that anything happening in our portfolios and in our capital structures can be put in perspective by people who are in much worse situations than we are. But as far as where things stand, to just zoom out, I think I'll start with some good news, which is very clearly inflation is moving into the rearview mirror, and we see that happening globally. And it's not just the prints you see from the federal government, but when we look through our portfolio, not just in real estate, but across our private equity companies, we have 200 companies roughly in the Blackstone ecosystem. When you look at input costs, when you look at wages, job openings, all of these things point to signs that inflation is very much coming under control. I'd also say, in good news, the financial system, we believe, is very resilient and is in so much better shape than it was in the global financial crisis. And so we can all, again, sleep at night knowing those things. But it does feel like we're a bit in the fourth act, or getting into the fourth act of a four-act play, where the first act was enormous amounts of stimulus being put into the system. The second act was all about the euphoria and the inflation that came because of that. The third act, of course, is trying to cool it all down. And then now the fourth act, we see ourselves living with the slowdown that will inevitably come when you put that really harsh medicine into the system. And I'd say, looking around our real estate, we are really encouraged that 50% of our portfolio is still showing really strong signs of strong cash flow growth. And that is super important in any environment, but particularly one where we're feeling the upward pressure on cap rates or downward pressure on multiples. But nevertheless, the air is coming out of the balloon. You're seeing rates of growth, even in the strongest sectors, come down. There's certainly some silver linings, of course. New supply coming down really significantly. This year, of course, you'll still see deliveries of apartments and warehouses that were started a few years ago. But when you look at how few new starts you have, even in the strongest sectors, that I think bodes well for very strong fundamentals out into the future. And then, of course, this was highlighted at the end of the last panel, dislocation, distress, capital constraints, that creates opportunities for all of us. And I think there's reasons to be really optimistic about the opportunities ahead.
Great. Well, and you have said you can't paint all of commercial real estate with one brush. And you probably know better than anybody because you're in so many different sectors. So I'm wondering if we could maybe dig in, because last year at this conference, all the talk was about a coming recession. And some people say commercial real estate's already in a recession. Some other sectors are doing really well. But I'm wondering if you could talk about maybe some of the differences you're seeing within asset classes, student housing, logistics, industrial, commercial.
Absolutely. So we have a highly concentrated portfolio. 40% of what we own is in warehouses. And that's $600 billion of real estate. So you can see we have big concentrated positions beyond warehouses. Rental housing has been a major theme for us, as has data centers and hospitality. And as I mentioned, if you look at 50% of our portfolio, warehouses, student housing, data centers, we continue to see very strong cash flow growth. And we see very high releasing spreads, particularly in a sector like logistics, where you have the opportunity to roll over leases that are 4 and 5 years old. So, for example, despite warehouse rent growth slowing to roughly 6% in the US and 15% in Canada, which, by the way, is still an astounding number, we see releasing spreads of 60% in the US and 150% in Canada. So this is really propelling strong performance. Of course, I think we've had, the last panel, trod well over office and some of the challenges there. We're fortunate that US office is only about 2% of our whole portfolio. But even there, our view is that you cannot paint it with one brush. New assets in dynamic neighborhoods with great amenities and the ability to attract tenants who are trying to grow their businesses, draw their people back to work, those are performing really well. And it's the assets facing obsolescence that are under more challenges.
Yeah. Since you're so weighted towards logistics, some of the recent news is that that's a bright spot generally in commercial real estate, but there are also some issues around energy supply, water, other things that might create headwinds and in specific parts of the country. And I'm wondering how you're dealing with that in your portfolio, since you're so spread across.
Yeah. Well, I think some of the issues you're highlighting are really more specific to data centers. When you think about power constraints, water cooling. Just by way of background, we took private a company called QTS about 2.5 years ago, and at the time it was about the 5th largest data center business in the world. And one of the things we encouraged the company to do, really required the company to do, was to go out and secure more land sites, and for the land bank it had, make sure we were securing power. And that has really positioned the company extraordinarily well for the environment we're in, where the major technology companies have made massive commitments, trillion-dollar commitments to their digital infrastructure. And I'll admit, when we bought the company, so much of the strategy was predicated just on the demand that would come from the digitization trends we were seeing at the time, the move to cloud computing. And what has happened is that AI, of course, has changed everything, and you see these step function differentials in demand. I will say, certainly in some of the I guess you could call it more traditional high demand hub data center markets like in Northern Virginia, you are running up against greater power constraints. And that's why it is so important to have assets that already have power contracts and have all of the equipment they need to fill out the data center if you're going to build it. But I think AI also creates an opportunity to diversify the footprint of a company like QTS, because the latency you need for the AI transactions is quite different than if you're, for example, running a computing for a trading operation or something like that, where you do need to be a lot closer to where that computing is happening.
Interesting. So, maybe this is a good time to talk about AI in real estate. It's certainly the hot topic. It's been a year since ChatGPT-4 was released, and I'm wondering how you see that affecting your portfolios, whether it be the logistics, data centers, or even just the way you're thinking about your business.
Well, in terms of using data and computing that data in our business, I feel really fortunate that our firm has a heritage of looking at the information that we have that's proprietary to us and using that to inform decisions. And this goes way back, long before we even had great data sets and we were really trying to create cohesion in that information. It was on legal pads and in Excel spreadsheets. And I would say for all of you, and as folks who might be thinking about starting businesses or using information, you can have access to the best information in the world, but if you don't have an investment process that uses it, it's kind of useless to you. And I find that's what I hear most from some of our investors, some competitors who say, how do you get your people to use it? Well, I'll tell you how. When you have to make an investment decision, you have to ask your team whether they've drawn from the insights of the experience you and your business are having on the ground. If you're expanding into a different geography and there's patterns you can recognize there that you have lived out in another place, ask if they've connected with their colleagues. I can tell you in our shop, you do not come to investment committee twice not having connected with that information, not having talked to the asset management professional, not having connected with someone across the world who is doing something similar to you in a similar sector, but just in a different city. And so I think what we're excited to see is the opportunities that just greater computing power, the ability to bring together data sets from the outside with the data sets we have on the inside can really help us inform. And I feel, again, one of the great things about our business is people were thinking about this ahead of ChatGPT, ahead of data science being clearly an idea for those of us in private markets, not just for people acting in public markets. And we have 50 data scientists at Blackstone. And today we staff them with our deal teams to really help penetrate a little deeper on questions and on potential opportunities. And I think AI is anywhere near replacing human judgment, but it is certainly helping us break down things like revenue drivers or what is really propelling cost increases so that we can just make better decisions around it.
Oh, interesting. So it's been hard to make decisions, right? I mean, one of the reasons is just the lack of deal flow. Mm-hmm. One is, sort of lack of trades, and right in this interest rate environment, lack of refinancings and things like that. We're starting to see a little bit of that, but I'm wondering where you find value discovery. So how have you been able to sort of figure out ways to price in the absence of some of the data we typically had, right? That would, I think both Rudin and others talked about just the lack of flow mm-hmm. and what that means for, price discovery.
Yeah. Well, certainly with all of the volatility we've had and with so much capital stepping to the sidelines, right, you see this muted transaction environment. And I think that's pretty natural in this kind of environment. And it's also because any seller who doesn't have to sell or owner who doesn't have to refinance is probably going to try to hold on until they're certain there's no more time or no better option. So that's certainly the case. But we like to say that we don't wait for an all clear signal. It's not coming. No one's ever going to tell you now is the bottom. And so I think what you have to do is try to bring together the information you have and refine and reaffirm your convictions, and then base yourself around experience and certain kind of tried and true methods, whether it's premiums to base rates or premiums to in-place cap rates or premiums to, or discounts rather, to replacement cost, and build that conviction to transact. And I'd say where you're seeing us invest is really where our convictions are meeting dislocation. And this year, it's been most prevalent actually in Europe that the sectors we like the most, so logistics and student housing, hospitality assets, data centers, where we're finding opportunities where over-levered sellers or sellers facing redemption pressures and liquidity pressures, or public companies who have their stock price under pressure but need capital to transform their business, we've been able to create opportunities there. And so I'd say there's a ton of consistency in the asset classes we're executing into. And part of that is we get more data than just about anybody. And we also have the ability to move quickly and offer solutions to people who are not going to run a fully marketed process, and we think we can reflect that in the values that we're buying.
Yeah, interesting. One of the other reasons is, of course, the collapse of some of our regional banks, and some of the headwinds in that space. I used to teach about bank runs, and I never thought I'd see them in real time.
Through an app.
Yes, exactly. And I'm wondering if you could talk about how the collapse of some of those regional banks might have affected your portfolios or your investment strategies. And I'm also wondering, because you're global, that seemed like it was a kind of local problem, but I wonder if it had ripple effects or if you saw in other countries where you're operating some of those similar sort of banking ruptures.
Well, I would say broadly, we had, first of all, we had virtually no exposure or direct exposure to the banks that have faced some of the most significant challenges. And I think, though, it was just kind of emblematic of the dislocation in the market and people's concerns with, in particular, where you had asset and liability mismatches. And I think it just brought greater focus from all of the banking system globally to say, okay, what do we have? How confident are we in the success of these investments? If you're a lender, you're making investments too. And how much more would we want to do of any of this? And what the result has been is just a lot less capital available, particularly for real estate assets and real estate transactions. And so if you look in the US this year, if you can look at new commercial real estate loans made by banks, you can look at securitizations of CMBS, both are down roughly 70%. And I think that's just, again, emblematic of an environment where lenders are moving to the sidelines, are not confident in their ability to syndicate or securitize loans if that's how their business model works. And where they hold loans, they may need or want to have less on the books. I look at all of this, any capital constrained environment just creates opportunity. And it's not just opportunity for the equity owners, but also if you're a lender. So we have a lending business. We have about $70 billion of AUM, really across the debt capital structure, everything from senior mortgage loans to mezz to securities. And in the last year-ish, we have originated or purchased or provided structured solutions to banks for about $1.5 billion of capital at mid-teens returns and sub 60% loan to values at origination. So it feels to me that while the things like bank failures create more nervousness, bring down sentiment further, that creates opportunity. And I really think your question is a great one about what did this do globally. I think it more than anything impacted sentiment. It makes folks nervous, and it makes anyone who has investors ask a lot of questions about the exposure you have to some of these more vulnerable financial businesses, and then also look through to what they own and how they feel about it.
Yeah. Well, and now we're seeing some of those portfolios come to market, and I mean, speaking of price discovery, I guess we'll discover where we end up on that. But it has to make economic sense, right? And so, I imagine you're looking at those and then figuring out, how to price it. Maybe it gets back to our question, about data and markets, because I know, particularly when we look at the rent stabilized portfolio, right? It's not just, the asset, it's also the policy, right? We talked about 421A, we talked about rent re-regulation, we talked about other things. And I'm wondering, you said you have 50 data scientists. How many policy analysts do you have?
Well, we have actually more of I call it the government relations SWAT team. I think I'm like an honorary member of that team, as was everybody on the stage before me, because so much of the work, if you're a real estate investor, is making sure you're aligned with the policy and to the degree you can, really influencing positive policy outcomes so that you can drive good results for your investors. And so, we don't tend to sit around analyzing policy, other than to try to figure out, okay, where are there ways we can help shape those outcomes and ensure that leads to good policy. So whether that's all the work the real estate community does around encouraging new supply, because new supply is the path out of affordability challenges. It was the governor hit on it, everyone else hit on it. We can talk about it some more too. Yeah. Whether it's how communities are organizing themselves to reinvest in renewal and things like that. I think that's part of the work.
Yeah. Well, and we were so lucky to have Alice Carr on our affordability panel, and one of the things they talked about was, with constrained new supply, your focus also on preservation of existing housing, and I thought that was interesting because it's I don't think what a lot of people out in the world think about, just how much housing we lose.
Right.
but that you can be a player in that, in sort of stabilizing and making sure that the supply of housing, that we already have, is financed and is operating. And I'm wondering just how those decisions, because that's a spin-off company as well.
Yeah.
Right?
So, yeah. April Housing, for those of you who saw Alice earlier, April Housing is a portfolio company within Blackstone Real Estate. We had bought roughly 90,000 units of rent-regulated, LIHTC built, meaning low-income housing tax credit built housing, primarily from AIG. And when we bought that portfolio, we created a company around it and asked Alice to lead it. She's been absolutely tremendous in what she's done. And we bought that company with lower cost capital that's perpetual in nature, meaning there's no pressure to turn it into anything else, but try to preserve it as high quality, affordable housing. And LIHTC has been the most successful public-private partnership possibly ever anywhere in the world in terms of getting the private sector to bring capital to build rent-regulated housing that in most places creates high-quality, affordable housing for people making 60% or less of area median income, which is, it is very hard for that population to find high-quality housing. And so what we wanted to do with the portfolio is try to address the challenge that when those rent regulations wear off, many owners don't really have a path to preserving it. There's many folks who have pursued, and AIG was doing this too, trying to make it market rate housing. That's not our goal. We want to preserve it, and unfortunately, one of the challenges with how the regulation was built in the first place, there's no simple path to having that preservation, to making sure the economics can work for the owner. But we're working at it one capital structure at a time, one state at a time, and I believe this is a great example of where our team, a company we built and purpose-built to do this work, and our capital can show that there is a way to do this in a way that works to generate great returns for your investors and great outcomes for your residents. And I personally would say I feel some responsibility for this. If we do not lead and show that you can do this, who is going to do that? And so I'm so excited by the work we're doing at April. I personally have spent a lot of time with that team, and I'm really proud to do it. And I really hope we can sit here in a number of years and say, there's thousands and thousands of units that we've been able to preserve and show a way for others to do the same thing too.
Yeah, and you're talking about sort of like the regulated affordable, but you're also in other markets that people might not think about as affordable markets, but they're providing affordability across a spectrum. And so one of them might be the rent-to-own market or the single-family rental market. And I'm wondering what your thoughts are currently on that market. I know it feels like it existed, but really after the sort of financial crisis, it really ramped up. And you're a big player there, but I think a lot of people don't talk about that as affordability. But when you look at some of the numbers, it's actually giving people pathways. I'm wondering your thoughts about sort of the current state of that market.
I love what you said. The idea that you can rent a high quality single family home is really giving a pathway into that home for people who otherwise couldn't have it. I mean, I'll just take a step back generally, and I know housing's been discussed here a lot, but when you take a nationwide snapshot, what happened after the financial crisis was that we never got back to building the level of housing of all forms, rental and for sale, that the country needed to meet the population growth, the household formation growth. And so today we sit like somewhere, we think 4 to 5 million units shy of what we need in the US for what I would consider a healthy housing market, where you're not facing large and fluctuating increases in rents, and where you don't have affordability crises really kind of rampant across the country, particularly in markets that have strong job growth. And we're believers that we should have housing of all kinds, whether it is the affordable rent regulated, all the way through to single family homes, and everything along the way, student, single family for rent, condos and starter homes. And our focus is exclusively on rental housing. And rental housing is in such high demand because, one, we don't have enough housing, and it is prohibitively expensive for most people to purchase a home. Today, because of the high cost of housing and the high cost of borrowing, it's 50% more expensive to own a home than it is to rent a high quality apartment in the market. I mean, and consumers are smart, right? When it's 50% more expensive, you don't do it, you rent. And that's buoying demand for rental housing of all forms. And I think in particular, when you look at the role that single family rental housing can do, it can allow families who otherwise might not be able to afford a home in a high quality school district, in a safe neighborhood, they can access that home. And we, after the financial crisis, we created a company called Invitation Homes, where really we bought homes post foreclosure. We invested roughly $25,000 of capital per home to really upgrade the home, stabilize that asset, and then also by extension stabilize the communities they were in. And that is a terrific public company today. We're really proud of it. We are unaffiliated at this point. But we saw an opportunity to re-enter the single-family rental housing market through a company called Home Partners of America, which we purchased. And Home Partners model is to allow would-be homeowners, people who want to buy a home but can't afford it, to bring a house to the company. We at Home Partners buy it for them, and we rent it back with an option to purchase over 5 years. And it is a super customer-friendly model. There's a lot of these kind of option to buy home models out there. I think Home Partners is definitively the most customer-friendly because you have very transparent disclosure on the rents over your whole your 5-year period. You also have transparency on the options. Because of what's been going on in the housing market, those options have been very much in the money for the consumers. And in the event they're not, the consumer just can walk away and say, you know, I don't want to get myself into a home that is now I could purchase for less than my option value. And so we have been really pleased with that company and the opportunities it's affording people. And in particular, we, because of the capital we have, again, long-term, lower-cost capital, have been able to also create a program called Choice Lease, which is really focused at people seeking affordable rental single-family housing, and helping get those people who, again, would otherwise, because of mortgage qualifications and otherwise never be on a path to home ownership. And so those kinds of models, I think, really can have a transformative impact on the housing market, but also on the people who are choosing to be residents in the communities.
Yeah, and I see that our time is growing short, but one, I just want to say how you hold logistics, data centers, rental housing, and your global portfolio all in your head at the same time is kind of amazing to me. I can try to learn some lessons there. We haven't talked about global markets, so I want to end on that.
Okay.
This past year, we took students to Brazil, Korea, UAE, and Europe. And it was amazing to see how disparate the kind of general economic outlook, office vacancy, residential markets were vis-a-vis the US. As one example, the office vacancy rate in Seoul was 2%.
Yep.
That was a surprise to me and everybody that we went with. As somebody looking and investing globally, what are some of the regions or issues we here at the US might not be focused on, whether a success story or a cautionary tale?
Well, I'd say, two things I think where the U.S. has opportunity is really in immigration policy. And I say two things. One is just generally, and then as it relates to students. So one of the markets we have been most enthusiastic about is Canada. And part of that is because the country has had a very pro-immigration stance. And this year, it was 2022, it had nearly 3% population growth. It's by far the highest in the G7. And 60% of the immigrants it's bringing in have bachelor's degrees or higher. So they're really trying to bring in not just immigration generally, but highly educated workforce. And we think that has many, many positive impacts for the economy in Canada broadly. We have invested primarily in warehouses and primarily in the 3 major cities, Montreal, Toronto, Vancouver. But we really see that that is something that, from a policy perspective, can really change financial outcomes for the country. Similarly, we have been big believers in student housing. We own the largest student housing business in America called ACC. We also own the second largest in the UK and just invested for the first time in student housing in Australia. And what you see happening in the UK and Australia is that the country's being very, very strategic, thinking about education as an export, offering very attractive visa programs, not just for students while they're there, but also to stay and work in those countries. And it doesn't hurt that the cost of education there is much lower than it is in the US. But I think those are kind of strategic policy decisions that those countries are making to say, we want students coming here, we want these minds to stay here and contribute to our economies. And from a real estate standpoint, again, like we were talking about housing and housing affordability, there's demand from these students for housing against a backdrop of insufficient supply in all these places. The US, certainly true, particularly in the markets where universities are growing and growing their student population, but really facing housing constraints. And in the UK, there's something like 6 times more student demand than there are beds available. And in Brisbane, where we invested, there's only 1% vacancy in the market. So that's having a spillover effect to student housing and the ability to grow rent. So we think those, again, it's just emblematic that policy does impact opportunity for us in real estate. But those are examples of something that, if I was running government in the US, I might consider.
Yeah, well, I think that's a great place to end, because you talked about maybe where our students should be looking, not just for opportunities, but also for lessons from abroad. And then also, I think the sectors that you talked about here in the US remain strong. So look for Blackstone and see what they're doing. And I want to thank Kathleen McCarthy for joining me today.